Hi, I'm Mark King, Head of EMEA Content at Columbia Threadneedle Investments. Joining me today is William Davies, Chief Investment Officer at EMEA, and we're going to look at some of the recent themes we've been debating and analysing in recent weeks and months, plus a look at what's in store for markets. Will, among the recent themes explored by you and your team has been electric vehicles. What impact do you see EVs having on the auto sector, and are there any wider implications for companies and markets?
Well, Mark, we've already seen the rise of electric vehicle sales over recent years, but over the next decade, that's going to accelerate as we get increased adoption as we move into the 2020s, and we get a large number of cars, new cars, coming to the market as well. We expect by the mid-2020s to see solid-state batteries within cars. That will help improve the range of electric vehicles, and that in itself will stimulate further demand for the cars. Elsewhere, we look at semiconductors as being an area where there will be increased demand for particular types of semiconductor as cars change, as we move to more electric vehicles. And obviously, if you look at the utilities that provide the electricity, then there will be more demand there versus the demand for petrol or diesel currently.
You've also looked into Japan recently and its changing demographics there. What does the future hold for Japan, and to what extent will those structural changes play a part?
Well, I guess the thing we can say, Mark, is that the changing demographics within Japan is nothing new. We've seen an ageing population for decades now. That obviously has an impact on economic growth, which in turn has helped keep inflation low, interest rates low. If you look at the wealth of the Japanese nation, though, I mean, GDP per head is still very strong or very high within the country. But if you're a company which is selling within Japan, a falling population obviously has its challenges for you. But I guess the important thing for Japan is that they are used to low levels of growth. They are used to an appreciating yen, and with that appreciating yen, they need to ensure that they can produce value-added or high-tech components and goods, and that is something which they have specialised in, and so hence they are learning to cope with those threats of a falling population.
China, a huge importance to the global economy, of course, but there is a debt issue there. What's your outlook for China, given that it's also embroiled in this ongoing trade war with the US?
If we look at the debt situation within China, undoubtedly we've seen rising debt over a period of time. Some of that debt is within the financial system, some of it is within the non-banking system. I guess when we look at this particular challenge for the country, if we continue to see the economic growth which we've seen over a number of years, we believe that the Chinese economy will be able to cope with the levels of debt that they see at the moment. If there are more tariffs imposed upon their exports, it's also not good for the Chinese economy if they're imposing tariffs on imports as well, because it makes it more expensive for the consumer. But if we look at the consumer in China, over the last couple of decades, they've contributed a similar amount to economic growth year in, year out. If we look at fixed asset investment, that has been more volatile. And so it's in that fixed asset investment side that we see, I guess, more challenges for the Chinese economy from the imposition of the tariffs that we've seen thus far.
Moving to the macro, Will, should we fear a recession at this moment?
So if we look globally, Mark, I believe that the trade challenges that we see in terms of the trade talks which are going on between the Chinese and the US do offer a challenge to the global economy. And if those continue, then we expect that, yes, there will continue to be a slowdown within economic growth. But it is not in the interests of the US nor of the Chinese to bring about a global recession, most especially in the US, given that we have an election in November of 2020. If we look at what has happened within the industrial side around the world, if anything, maybe we've already seen a recession as we've gone through 2019. as we've seen purchasing managers' indices decline over the year. But interestingly, as we come into the final third of the year, these appear to have stabilised. So the worst fears we had over the summer, that maybe the trade talks were leading to a hit to investment spending, appears to have levelled out. And in that respect, we expect that reasonable economic growth as we go into 2020 is the most likely outcome.
And of course, the US consumer has held up reasonably well.
Absolutely right, absolutely right. And one of the things I've always been taught within economics or within markets is never underestimate the ability of the American consumer to consume. But so they should. Unemployment is very low within the US. And so, yes, investment spending may be challenged in certain areas, but consumption with low unemployment remains quite firm.
And finally, a word on markets. Are you happy owning risk assets today? And what are your thoughts on the merits of equities versus credit?
If we look at markets at the moment, our forecast is for relatively low economic growth, relatively low inflation and relatively low interest rates. In an environment like that, the current value of future cash flows is relatively high given the low discount rate. But do we believe that we'll see similar returns in 2020 to those we saw in 2019? That will be a bit of a challenge given the strong markets we've seen in 2019. But nonetheless, positive returns in 2020.
Will, thanks very much.
Thank you.